All right, everybody, we'll get started here. We'll start off with just some stock indices and information there. And as a reminder to everyone, this is what we've been putting in the sectors report for several weeks. This is there's a couple of columns here. It's broken down for each month, the average returns per month, with the green being the best, rated to red. So you see the darker the color, the lower the performance of the average month. And then the third column is the percentage of the time that given month is higher. So we've been sharing the last couple of months that August is typically the second to the weakest month of the 12, with the month that we're starting now, September, being the weakest month. But one thing, to look at also is July doesn't fall far behind as a month that's not up a lot, and you can see that its percentage of the time is higher. It's just about half the time, even though its gain is about 0.8%. Again, I don't believe I'm going to continue to share this, and I think we should be empowered by knowing this data. But just because it's typically September a soft month does not mean that one, in my opinion, should be bearish. And we're not bearish on the markets with the trends being higher. I think it's obvious by the positions that we own. We'll see how September unfolds. It obviously one day doesn't make a trend, but the market got off to a very soft start for the month of September, today. But again, as a reminder, September is usually the softest month of the year, and it's up less. It's up about 45% of the time over roughly the last 36 years. So I was just kind of mentioning that July is not typically that hot of a month, but so I kind of looked at, we think we just are finishing a 90-day period, which would encompass July, August, and September. And so this is a performance of some of the major indices over that period of time. You can see in the blue box at the bottom of the screen that the S&P is up an average of it gained 1.52%. I took these numbers roughly at midday today, and it was kind of ironic that the Nasdaq came up with the exact same number during that period of time. Small caps were up a little less, with mid caps being the weakest in that 90-day period. So I think the bottom line takeaway is so far, or over the last 90 days, the market's been fairly and its returns been fairly historical as far as what it usually does. Softness during that time of the year. You've noticed that we haven't talked tons about buying the indices. We've tried to buy certain sectors and tried to buy stocks that tended to outperform the markets, and overall we've had some good luck with many of those. But the indices, not a lot to write home about if we bought it 90 days ago, to just be up 1.5%. Nothing terrible, but also nothing typically too exciting in this time frame, and it kind of panned out to be true again. So as we look forward, this is from good friend Ryan Dietrich, these tables. This is the average performance of the S&P in the month of September from 1950 in the upper left. So we're talking over half a century, and then the lower right is the same month, being September, just over the last 20 years. You can see the numbers come in fairly close the same. So on average, the first half of September roughly is slightly up, with the softer part of September typically taking place in the last half. So we'll see how that turns out. But again, everyone, these aren't dramatic, numbers, but on average, this is the weaker time of the year if it's going to take place. One of the things I found from Oppenheimer recently that was interesting, a lot of noise here, but it's looking at the average September performance, but it had a qualifier. If the S&P was above its 200-day moving average, the gains are in gray. And if the average performance of each given month, this is July, as you can see at the bottom, July, August, September, October, November, December, but then the performance when it's below the 200-day moving average. So you can see that September is historically quite weak in times that it goes into the month below the 200-day moving average. And the average gain actually, when it's above the 200-day moving average, is actually to the plus side. So it doesn't mean it'll come true, but when we look at stats from this direction, on average, when you go into the month of September and you're above the 200-day moving average, September is actually positive. So we are going into the month above what a lot of people consider a line in the sand. Are we above or below the 200-day moving average? But I found this with kind of an interesting stat from Oppenheimer. Puts a little bit different twist on things. So we're going to kind of start off with, and we'll dig into each of these charts, but this is the S&P in the upper left, the bank index in the upper right, Russell in the lower left, and transports in the lower right. We'll dig, like I said, we're going to look into each of these individually, but the bottom line from a 30,000 foot view, all of these are in uptrends, and each of these are facing some overhead levels, resistance lines that seem to be causing a little bit of heaviness to each of these. So as we dig into and look at the S&P first, you can see this rising wedge that's taken place, and even if the wedge, was not there, you can see that for the most part, it's been a lot of choppiness now for several months, and with momentum very elevated, actually in one of the higher levels that we've seen in quite a while. So I do believe that the resistance that's just above the market and support that's just below it is having some influence on buying and selling decisions by people around the world. As you can see that when it's tended to hit the top of this range, buyers have dried up. And then a few weeks ago, again, this is a weekly chart, when support was hit, some buyers came back in. But this is really a narrowing pattern that's going to have to come to a conclusion one way or another, that we have a breakout or a breakdown. But not a surprise to see some choppiness, in my opinion, with this type of a pattern, at hand for the big stocks. Moving to the bank index, this is a chart going back almost 15 years, and the blue and the green shades are a couple of different long-term channels. This really affected banks for a few years, almost 5 years, until the financial crisis. You'll notice that this was a support level, and then once it broke, boy, banks really started a waterfall pattern down. Then they came back up, and there was a 1 week reversal where it tried to get back into this channel, and then the puppy just fell apart from 70 bucks a share down to 20. So on a percentage basis, we all know that's just really a huge decline. And I just found it interesting. We've drawn that channel and extended it into the future, and lo and behold, the beginning of actually around Thanksgiving, the bank index came back and kissed this the underneath side of that channel again. It's kind of hard to see, but right there is a bearish reversal wick. We've seen a little bit of a decline, and then a push back up just underneath this resistance. So right now, banks haven't done much now they're actually lower than they were at the beginning of the year, and they've continued to, I believe, be influenced by dual overhead resistance. And historically, to see stocks do well, you'd like to see banks participating. So actually, the bank index divided by the S&P has been weaker than the broad market. But again, this is still, in my opinion, stiff overhead resistance that for this bull market to continue its upward trend, it needs to take out both of these lines. And for months, it's struggling, and there's a chance if we see selling come in that we can make the case of a potential double top in banks. So we'll talk about later, we are long still some shares of XLF and also own Citi. And so we've, because of this situation and all of these resistance lines we'll discuss later, we've got stops pulled up pretty tight. This is a look at the small caps over the last 20 years, and nice rising trend. The red line here is the 200-day moving average, or it's the 39-week moving average, since this is a weekly chart. But you can see, similar to the other indices, that this long-term channel has been in play. We've seen a lot of choppiness. The weakness in the small caps did hit the 200-day moving average a couple of weeks ago, and then we see a fairly sharp rally, and actually a relative strength rally, as small caps have been weaker than large. And over the last 2 weeks, that doesn't make a trend, but small caps have actually been a little bit stronger than big caps. But overhead resistance is still in play, and as I will say over and over with these, this is, with the trend being up, that's where the strength is. But we also, being long in any of these, if you own these long positions, this would be one of the least interesting places to see selling start taking place. That would be concerning to me to a long-term trend if this happens, this resistance holds and sellers start coming forward. Not taking place so far, but that is what, in my opinion, the bulls would not want to see. We've shared with this many times. This continues to be in the sectors report. This is a transportation index, and if I use this all the time, and I imagine most of you do. But if we had looked in 1998 and just drew a horizontal line, it would appear on this decline by transports as they came back. It would have been easy to say, hey, we have a breakout. We have a breakout at both ones in 1999 and 2008, because it did edge just a little bit higher. And once that took place, instead of a breakout, in hindsight, in a rearview mirror, it was a perfect fake out, because it probably attracted the last dollars. And then both times transports fell over 50% in value. And this chart is not about the size of the decline, it's all about the pattern. So the pattern in the upper right has some similarities. I still think, as I continue to share in the newsletter, that this is a low probability odds that this pattern that I'm sharing is correct. But again, the odds may be low, but the impact would be big, in my opinion, if it continues to repeat, especially if the rising support at 2 would happen to break. So bulls really want to see transports remain above rising support 2. A very cautionary to concerning message would be sent to the bulls if support line 2 would be taking out, because then it would slightly start increasing the odds that maybe we have a repeating pattern at hand. A look at the Nasdaq. It continues to be in its long-term, uptrend. Last week it did close at a new weekly high, so some the positives are still taking place, in tech. The one chart that I'm going to share on a different date is, again, that Amazon 2 months ago had one of the largest bearish reversal wicks ever. So we'll see if this company that a lot of us might be buying goods and services from, if that huge bearish reversal 2 months ago is going to be important from one of the largest companies in the world. From a long-term trend, this is the advanced decline line on a weekly basis, and again, in the parentheses in the upper left, what's kind of, to me, it's not any credit to us whatsoever, but this is just a look at common stock only. We continue to discuss this, that you can look at the AD line that is beyond common stocks, which would have closed-end bond funds and of the like. So we just try to, strip that out. The trend is completely solid. It remains in an uptrend inside these blue lines since 2009. In the upper right, it's very close to all-time highs. You see it backed off, and it's made a little bit of a run back. So we're seeing nothing but positive news coming from this. I think the bulls would get a concerning message if dual support at 1 would be taken out. So we continue to share this chart each week in the global dashboards report. So nothing but a positive message still coming from the long-term AD line. This is a look at junk bonds. Junk bonds continue, I think, to be important. That oftentimes early in my career, I guess it was my 18th year in the career in the late 90s, junk started diverging against stocks in 1998, and junk was sending a very appropriate message that stocks could be in trouble. So I continue to believe that this is a very important sector to look at, even though these are bonds. You probably heard the phrase that junk bonds are stocks in drag. They're imitators. So for the last several months, as you can see, there's a resistance line. For almost the last 5 months, junk have just trended sideways, not given a positive or a negative message, but the overhead resistance appears to be heavy. Hasn't been able to break through, and you can see at the top that since almost for a year now, the momentum has created a series of lower highs at 2. So price is everything. So price is still below resistance and above support. Obviously, the positive message that long positions would want to see is a junk breakout, and a concerning message to the bulls would come if this rising support around the $35 level would be taken out to the downside. Right now, it's still a positive message, but almost a mediocre positive, because it's just been chopping sideways. But no concerning messages as far as divergences and weakness coming so far from the junk complex. So I'm gonna just as a quick reminder, this is the whole world in a way. The upper left is the S&P, Dow, and the Nasdaq. Middle row is Russell, mid caps, and value line geometric in the middle, and the lower is Germany's DAX, with France in the middle and London in the lower right. So just from a 30,000 foot view, all of these, the trends still remain up. The two that we'll dig into the most here that could have some concern is the DAX and France, and we'll look at that individually. So I apologize, this chart was just a piece that I meant to cover up. So again, a reminder of how June or August and September are typically soft. So the two charts that have me most concerning from that 9-pack that we just looked at would be the possible messages that could come from Germany and France. So these are both the same charts on the left and the right, just the right chart is a little closer look. But you can see that the DAX remains in a long-term uptrend. This was the 2015 high. You can see that earlier this year it did break above it, probably pulled some buyers in. You can see it off to the right. It was probably above this for a couple of months, 60 to 90 days. But the thing that has my attention the most is that it's now back below the 2015 highs, and it's also back below the rising support line off of the lows in early last year. So this is something that the bulls would get a concerning message, in my opinion, if the DAX continued to be weak. You'd like to see the world going along for the ride, and there is some softness here. At this time, I would not characterize this message as bearish, but if it continued to, we'd see some selling and break below this shelf here, it would for sure, in a minimum, send a caution message to stocks in the States. But again, it is facing dual overhead resistance at this time. And then as we look at France, it actually is reflecting a little bit weaker picture, but something similar, the same, that here's the 2015 highs. Again, both charts are the same, left and right. The right's just a much closer look, but you can see that it tried to break above 2015 highs, and now it's slipped below those old highs and also back below rising support. And you can see this over here at 2. And it would not take much. It's probably working on filling that unfilled gap. If you kind of could picture a horizontal line across here. So if it would fall on close below this low of 5 weeks ago, that would send at a minimum a cautionary message to stocks in the States. So I do have these on. I'm sharing these with you because they are a little bit of a concerning message to the bullish case or long positions, especially as we're in the months of August, which is now obviously behind us, and September. Another, just an update of the equal weighted, cap weighted. For any of you that are not familiar, this is RSP divided by SPX. RSP is the S&P 500, but all shares are looked at equally, hence the equal weight versus the cap weight, which that's what the S&P 500 is. And what this reflects is that since essentially the first of the year, the ratio is going down, which the take from this would be is that fewer and fewer stocks are pushing the market higher, and to really have healthy runs, you want to see this ratio heading higher. In my opinion, this is not a bearish message at this time, but it is a cautionary one because fewer and fewer stocks are pushing the market higher, which makes it harder in a sense because there are fewer going up, and so you have to be really right as far as just picking those few that are pushing it, much higher. So over the last 3 or 4 weeks, you can see the ratio is actually could be bottoming, but again, it does remain in this downward trend. The red box just reflects how long this ratio has been heading lower. One of the things that kind of intrigued me was if any of you are familiar with the Direction company, they have many ETFs on the long and the short side. They have just 1x shorts, they have 2x and longs too, don't get me wrong, they have both sides, and they have 3x positions or 3x ETFs. But the one thing that intrigued me is all of these ETFs that you see on the screen, Direction is closing, and they're closing these funds, and they're closing all of these funds, and in the yellow highlights are the ones that are closing, and you can see the majority of them are bear funds. And so it'll just be interesting, everyone, in time. Was this a move? Did Direction happen to go close the bear funds at maybe the polar opposite wrong time? So this doesn't have much to do with charting. This is mostly a sentiment observation, but we'll just see where it goes. And it would just really be ironic if this market would happen to peak in here right at the time direction did this. So because of the resistances that we've looked at in the long-term charts and the seasonal time of year, we'll look at our positions later, but we do have a lot of longs and almost fully exposed to the market. But with that exposure, I'm pulling up stops that probably are tighter than normal in a bull trend. And so this is my way of trying to do risk management, of still trying to go along with the trend, but also understand that resistance is in play and we're facing a possible or a historical seasonal softness in the markets this time of year. So that's our way of trying to position ways around this. If this market would turn soft, totally open to if we can see the AD line go weak, the shoebox indicator go weak, junk bonds go weak, and some support break. Totally open-minded to score on defense. We're not a bull or a bear shop. We're open-minded to making money in either direction. So a little bit of just kind of a reflation theme that isn't update, that isn't talked about a lot these days. But this is a chart we've shared a few times. So the blue line is the copper gold ratio. So typically when you see this going up in its own way is positive, that copper is outproducing gold. And historically, a lot of times that is a reflection of growth in the economy. So, or maybe it's just growth in copper. But needless to say, this started turning up in 2016 before the election. This is a reflection of that reflation theme. So you can see that it is now breaking out above, let's just call it the Thanksgiving high, which is a positive for copper, potentially reflects some strength. But the thing that kind of intrigues me, everyone, is that when we overlay in the red is the yield on the 10-year note, that you can see the two are fairly well correlated over the years. And something that we're seeing the last few months is actually a divergence between the two. And very humbly, I don't know what to take from it other than we're seeing a yield breakdown, and strength in copper is causing this breakout. We know that gold's not doing poorly at all, but copper in the metals complex has been the place to be, and we were both lucky and blessed to have owned Freeport for the last 100 days or so. That was much stronger than the S&P and much stronger than gold and copper itself. Freeport really, treated us well. And as most of you know, we closed that position, took the profits as a stop was hit, a couple of weeks ago or last week. So an interesting divergence is taking place. Maybe one of them is going to do a game of catch up. So is copper going to happen to go weak and catch up with falling yields, or are yields getting overextended to the downside and being fooled by what's going on around the world? So we'll pick this up again going on in the future, but again, I kind of wanted to highlight this kind of a rare divergence taking place. So this is a look at our inflation indicator, which is taking the TIP ETF and dividing it by TLT. Another tool to try to look is the world growing, or is it more in a mode of disinflation or deflation? But overall, you can see that the indicator is in a multi-year downtrend, the pink shaded channel number 1, since the 2011 highs. Earlier this year, when the reflation theme, if we would do most likely a Google trend search, reflation was talked about just all over the place. And about the time it became popular in March, it was hitting dual resistance at 2, and it's just completely backed off since then. So a big test for the inflation indicator is taking place right now, because it's hit support, had a counter trend rally for a few weeks here, and now it's falling back again. So if support would fail to hold here, it would most likely say maybe there's some concerns by participants around the world about the growth story, and most likely that yields would be falling and bonds would be rising if support breaks at 3. So speaking of along this line, we're going to look now at bonds and interest rates. Here's a friendly reminder of yields over the last 25 years. They remain in a uniform downtrend inside of falling channel 1. And you can see that in the last summer, the summer of 2016, yields hit what could be a double bottom, and they rallied sharply. Just took a few months to come up here and hit dual resistance. Potentially a double top in yields took place. This is where you'll see later that we suggested before the start of this year to buy AGG, which was the aggregate bond fund, which is a pool of multiple durations of bonds that we bought. We bought it right here, and so the yields have fallen since we purchased AGG, and bond rates have rallied. There was we've discussed it a few times in the sectors report, that there was a large unfilled gap here. You can see that yields after the double top came down to that fill, had another counter trend rally. And then as of this week, we saw yields declining again today, and they're working on breaking this support line at 3, which historically is bearish on yields and bullish for bonds. So here's a look at, speaking of bonds, TLT. We've owned TLT now for a few months, and TLT hit rising support about the time that the reflation theme was popular, reached its popularity around the March. You can see that support was hit, and since then TLT has rallied up and hit resistance, came back down and hit support, and now we've had another rally. So this is a big test for bonds in general, whether we own them or not, but the TLT position is owned. And as of, I think it was last week, we actually pulled stops up in case this would happen to be a double top. If not, I may even back the stop off. But if TLT would happen to be peaking and reversed, if it would happen to reverse, we'll be taken out of the position with a decent gain. You can see our stop is in play at that 126.28. If we would see a breakout here in TLT, it could attract, excuse me, probably a good deal of buyers. So this is a really big, important price point for bonds and yields. This is the AGG bond fund that we suggested to purchase. You can see on December the 14th, made a lucky purchase on this low. AGG rallied and then came back, so there's a potential double bottom, excuse me, in place. The rally in AGG has pushed it above this falling resistance, and last week it had some concerns that this was really a pretty large bearish reversal pattern right at prior highs. Excuse me. So that was one of the reasons that we pulled the stop up on TLT. Obviously, it's early in the week. This weekly action right here, everyone is just a single day. It's just today. But AGG had a rally. It is attempting, excuse me, to push above these prior highs. So far at this time frame, still a bullish pattern, bullish strength is taking place. Like I said, we've been long now. That would make it 9 to 10 months. We've got some capital appreciation on the position, plus the dividends that have been received, so it's treating us okay. One of the things, excuse me, I'll get a drink of water here. Just want a reminder of the seasonality on TLT. Ryan Dietrich pointed it out on the blog today that it shouldn't be a surprise that if historically August and September are soft, that then if we do see typical teeter-totter effect, non-correlations between stocks and bonds, that August and September in bonds could do fairly well. The average gain for TLT, you can see in August is around 3%, with the average gain in September coming in at about 1.5%. The size of those gains isn't, to me, is as important as what you historically see, that somewhere around the 1st of August through the end of the year is the quote-unquote favorable time of year to own bonds, that they typically do well. It kind of did catch me by surprise. This is the bullish sentiment on TLT itself. You can see the small decline that TLT suffered in the last couple of weeks actually caused sentiment to drop off quite a bit. So bulls on TLT right now stand at roughly between the 35 and 40% range. So if TLT would happen to break out to the upside, I think it would surprise quite a few people. I think that could spell a positive for the bond position or ownership of TLT. I would be much more concerned if TLT was facing resistance and we saw 80% of investors bullish on bonds, which they're not at this time. Here's a look at the stock to bond ratio. We're creating this by taking SPY and dividing it by ZROZ, which is one of the more extreme bonds that we can compare to stocks. It's the zero coupon bond. So a person that would own this would, if you're looking to collect dividends, this would not be the ETF you'd want to use. But if you want to get high standard deviation and movements, ZROZ would fit the bill. So in dividing the two, you'll notice that earlier this year in March, when the quote-unquote reflation theme was at its frenzy, if you'll remember back in March, if you look back in the sectors report, I did a piece that I questions if a popular delusion was taking place. I was citing the book that John Templeton has suggested to me as one of his best or most valuable reads outside of the Bible. I believe that reflation theme was a little too popular, too prevalent by so many people. And it's kind of ironic that the stock bond indicator peaked around that time. And it hasn't fallen apart by any stretch, but it's interesting that it did peak back at 2014 highs. As this declined from 2014, this reflected that the S&P was weaker than ZROZ. We've seen since March that the S&P has now again been slightly weaker than the broad market. To me, this is a very important support zone test that's taking place. If we would see a break of this support at 2, it would suggest that bonds are reflecting a good bit of strength, and would be reflecting that bonds are doing better than stocks. So this is a big price test for this ratio as we enter this month of September. So this is the opposite chart that we just looked at. This would now be, instead of the stock bond ratio, this is the bond stock ratio. And so what is a possibility, this was again March of this year when it hit the 2014 lows. This pattern's anything but proven, but at the least, this could just be a base that it's building to push higher off of. There's a possibility this could be an inverse head and shoulders, with the neckline test taking place at 2 plus 2 other overhead resistance lines. So if the ratio would happen to push higher out of here at 2, it would really send a positive message to ownership of bonds, and it would put into question that some selling pressure could definitely be taking place, in stocks. So a really big test, in my opinion, for both the stock bond ratio, which is testing support, and the bond stock ratio, which is testing resistance at 2. So just a quick look at valuations. This is 4 different valuation measures from my good friend Doug Short. Folk had a good email exchange from one of the members asking about valuations, and I would encourage you. There are many fantastic sites out there, and this is one of them that Doug provides. You can find it by first looking at Advisor's Perspective, or you can type in dshort.com and it will lead you to this. But this is, I just like this, just real quickly run through it, the 120-year look at valuations. There are 4 different measures included in this. So don't look at this as a noisy piece, but instead of trying to say, well, this indicator valuation tool is better than another, this is just laying 4 of them on top of each other. You can see where 1929 came into play. 1965 came in here, that for a lot of you, if you're not historians, may not mean a lot. It was, well below 1929. But the thing that I guess gets my attention because it was impactful to me is I got into the business right here in 1980. And so from 1965 to 1980, the market went nowhere for 15 years. And so it went from overvaluated or expensive to very, very cheap. And that's where the long-term bull market started. Here was the peak in 2000 in these indicators. Here was 2007. So you can see on the right that most of these are back to 2007 levels, nearing 2000 or 1929 levels, and still well below what I would consider the aberration in the late 1990s. So again, this does not mean that just because these are overvalued that the market has to stop going up here. The trend is your friend. Someday these are going to matter. They don't matter until they matter, but I truly believe in my heart someday that they're going to matter. But in my opinion, this does not mean to be bearish on the markets whatsoever. But I think we all have to look in the mirror and say that historically, no long-term bull market in the history of America has started from these current levels. But again, that does not mean it has to stop here. But 5 years from now, these type of indicators would suggest that the overall return of the S&P would probably be below normal returns because of how high valuations are at this given point in time. Another look at the Buffett indicator, another valuation tool, which is taking the gross value of all the corporate equities divided by the gross domestic product of the United States. Again, a 65-year chart, good period of time. Here was the mid-60s when it was overvalued. Here's 2000. Here's 2008, and you can see that we're not as high as we were in 2000, but we are higher than probably from 1998 and roughly 1997, 98, and before. So we're again in rarefied air. And then here was the financial crisis, to give you an idea of readings. The market's up a lot of years in a row coming off that low. But again, most long-term bull markets don't get started at these kind of valuations, but it does not mean that the trend has to end at this time. One of the things that this is the CNN fear greed sentiment, just to kind of give you an idea. You can see it vacillates from excessive optimism to pessimism, and right now it's near the mid-range, about 50. So nothing from, this is just one single indicator, but from the CNN fear greed indicator, about mid-range. One of the things that always interests me is looking at the margin debt ratio. And Doug and Jill that's doing these charts at Advisor's Perspective, they have several charts. I'd encourage you to go look at their margin debt charts, but one of the reasons I like this one is the blue line is the S&P and the red is margin debt. And the only reason it's going down is they invert the margin debt to show you the spread between the two. And so I really like this one to show some form of dramatics. If you've been a member for a while or looked at the blog, every once in a while we'll talk about fish mouth spreads, and we got a big fish mouth spread going on right now. But you can see the spread between the NYSE and inverted margin debt. You can see the distance in 2000, and again you can see the distance in 2007, and we're much greater now. As we've tried to highlight numerous times, to me it's not the idea that margin debt is high is bad. It's just when it's really high and then it starts coming down. In other words, all the people on margin are saying, hey, I need to start paying that back. I don't want to have this type of risk. That's typically where the markets can run into trouble. So what if we would see this start going up, or in other words, if this wasn't inverted, if margin debt started decreasing, that would be a caution signal that we wouldn't want to pay a good bit of attention to. You can kind of see even right in here when the margin debt started heading up, in other words, people were withdrawing or reducing margin debt, the market did sell off. It didn't crash or decline 50% like it did the other times. And this is not about that the market's going to decline 50% again. That's above my pay grade. But what I want you to be aware of is if margin debt that's at historical highs starts really pulling back, that could be a real caution sign for the market. So now we're going to turn the table to look at gold, silver, and copper. And this is the gold-silver ratio. We're taking gold futures and dividing them by silver futures. And to really be long and strong, back the truck up from a metals complex, you want to see this ratio going down. In other words, that gold is weaker than silver. So there's a possibility that we could have a topping process in this ratio. Even if it's not a topping process, it could be an upper level base. Obviously, a base could be built to push higher off of. But I think that the key to this, whether it is a head and shoulders top, is if we would see weakness, and if support line 1 would break, it would be a real positive for the metals complex, because it would show or reflect that silver is much stronger than gold. So that would be, if this support breaks, you probably would make money being long gold, long silver, or long miners, or all of the three. So the ratio appears to be up against resistance. And if you're bullish metals, you really would like to see this reflecting some softness, and so far we're seeing some of that. So again, the big key would be, to me, this ratio around the 67 level. Can it break this support? A look at the gold-dollar ratio. Gold had been much stronger from 2001 to 2011. Obviously, 2001 is not on this chart, but the ratio went up for 10 calendar years in a row, peaked in 2011, and has continued to make a series of lower highs. But the thing that intrigues me right now is this possibility that the ratio could be making a base. To be long metals, you want to see this ratio going up. So at this time, it's a really key resistance test for the ratio, as if you look into late 2014, the ratio is about at the same spot. So it's testing the top of its almost 3-year trading range with momentum fairly lofty. But if we'd see a breakout take place here, which would reflect gold strength to the dollar, this would send a positive message to the metals space. Here's a look at copper, and since 2011, copper has created a series of lower highs. We, one of the choices that all of us have, if you like the look, say, is an example of copper. You could buy copper futures, or you could buy JJC, which is a copper ETF, or you could buy in its own way a leveraged play, which would be a copper miner. And all of you know that that was our choice back in May, a little bit over 100 days ago. As copper was testing support in here, we liked the looks of copper. So we elected to go buy Freeport-McMoRan. And so it's treated us well, but you can see that copper has done well. It's broke above dual resistance here at 1. And now the rally that copper has had has it testing falling resistance at 2. And copper is also reflecting the highest momentum, relative momentum since 2011, in the last 6 or 7 years. So as all of you know, we started harvesting Freeport into the potential resistance, and this is a weekly chart, so one day does not make a trend. But you can see that there's a potential reversal taking place right here just below resistance. So quite a few copper bulls out there, and I really enjoyed the ride that we had. We're out of Freeport, but I'm not closed-minded to rebuy it again if Freeport would happen to break out above certain resistance levels. But again, a big test of resistance for copper with momentum and bullish sentiment really pretty high. So and just another reminder of the silver-gold ratio, that if you want to be long gold, silver, and miners and really back the truck up and do well, you want to see this ratio heading higher. It hasn't for several years, but again, it is down at levels where some quality rallies have started. So if we'd see a turnaround in here and we'd see this ratio head higher, there's obviously a lot of room that this puppy could run to the upside if this would happen to be the time. So moving on to the oil space, this was just a kind of a reminder that this is taking commodities and dividing by the S&P 500. We discussed this last month, but just as a long-term perspective, commodities that they're not on a lot of people's radar screens, understandably, because they've done so poorly, since 2011. So when you look back over the last 50 years, roughly, you can see that historically commodities are closer to bottoms relative to stocks than to highs right now, versus you can see back in 2008 where things were reflecting that commodities were close to a high. So this is a look, just an update on crude oil on a futures basis weekly. You can see that since 2014, for the most part, the trend has been down. Really for the last year, we've just seen some choppiness between the 54 and the 41 dollar range. To me, the big key is this falling resistance line 1 that was met earlier this year. There was this strong rally that came up, just kept banging on that resistance line. Buyers dried up, and some sellers have come in. Not a ton of selling, but still there's a good bit of resistance, right at the lower 50 range, just, overhead. So not a lot of positive action as far as at support or at resistance at this time, kind of mid-range, between the 40 and $50 level. The one thing that is closer to an extreme is the positions by traders. This was in 2014. You can see this was the most crowded trade in many years, and in actuality, it's the most crowded trade in history. The dumb money had loaded up to the long side, and they got spanked pretty hard as crude oil was around the $100 range, heading to closer to 30. So you can see early last year, a lot of the traders had switched, and crude oil then was closer to a low than a high historically when traders had taken those positions. So again, right now, you can see that traders aren't too far in their accumulated positions than the 2014 scenario. So there's a lot of bets. A crowded trade is that crude oil historically, if this barometer is accurate, crude oil right now is closer to a high than a low. If crude oil would happen to break, I'd say the $40 range, which is the bottom of the sideways channel, that'd be pretty painful for these people in the positions that they own. So even though crude's been sloppy, not a lot of opportunity in either direction over the last year, this would suggest an opportunity that if crude would break to the downside, that there'd be a lot of long positions that would need to be covered, so you could have the opposite of a short covering rally. Here's a look at energy ETF. Anything that's done poorly, one of our key strategies is TBNM, which stands for tops, bottoms, and no middles. Anything that's getting hard hits and run over is on our radar screen. And so if you look at the key 9 S&P 500 sectors, energy stocks have been the place not to be, other than to short them. So I did place a Fibonacci on the 2016 lows. That's where crude hit a low. The highs of this last year, 2016, close to the end of the year. So right now, the energy stocks have lost almost 50% of this rally. This is the 50% Fibonacci ratio. And there's also a potential support line coming into play. So this is in each week's sectors and commodities reports on Fridays. So I do have an overhead buy alert that if we'd see, right now the trend is down, but we're always open and watching for reversals in areas that people have no interest in, and the energy stocks would kind of fit that bill. So if we would happen to see, for whatever reason, some strength in energy stocks, I'd get a buy alert, and I would be very open to being a buyer. Don't own them right now, open-minded to it. This is another look at in the energy sector. This is the oil and gas exploration stocks. They've even struggled more than the major energy stocks in XLE. But we can see that a potential bullish falling wedge has taken place. And you can see that XOP is up against falling resistance at the $31 level. So just want to let you know that I've got a buy alert in, that if XOP breaks out to the upside, I will be looking to be a buyer of this set of energy stocks as well. So totally open-minded to this, you know, when so few people like them after being hit so hard. It's been a great place to avoid, obviously. We'll just see if it's a place to go long in the near future. Just a kind of a last look in the energy and commodity space. This is the Thomson Reuters Equal Weight Commodity Index going back 40 to 50 years. And this is a monthly chart. You can see that in 2001, the huge rally took place in commodities, and where the overall index peaked in 2011. In 2014, we shared that we thought this was the right shoulder of a giant topping pattern. So commodities have declined. They came down to hit what is potentially neckline support, which one of the lines were drawn off the 1980 high. You can see the 2008 lows here. In 2016, it hit that support. So we've seen a counter trend rally. It came up and retraced 23% of this huge decline, potential double top, and then they backed off. They hit rising support here a couple of months ago, and we've seen a small counter trend rally. So the bottom line is we've got choppiness going on. We have a pennant pattern on a monthly, long-term monthly basis that continues to compress commodities. Commodities, again, as we said earlier, have been the place to avoid for years. They're not on many people's radar screens, which puts them on our radar screen looking for potential lows. If this index would obviously break rising support, that would be a message of disinflation to deflation, a negative for commodities. If we'd see a breakout to the upside, we'd see obviously a bullish message for commodities, and especially if the index can get above this 23% level. If the overall commodities Thomson Reuters Equal Weighted Index would break above, what is this, 450, 40, 30, roughly the 430 level, about 5 to 7% above current levels, that'd be one of the more bullish signs that we've seen everybody in quite a while. So not any clear picture taking place. It's a compression, frustrating both bulls and bears. But if we break out again above the dual resistance here at around the 430 level, that'd be really bullish, especially because it's still above this 17-year rising support line. So getting close to finishing up, but just kind of wanted to share, even though the summer is over and we're entering fall, whether it's ironic or not, but this is a look at, in the upper left, corn seasonality and soybean seasonality in the right. And I shared this with all of you that are sectors members. I mean, all premium members saw this last Friday, is that some of the better times of the year for the grains start roughly about 30 days from now. So I know it's 30 days out, but we have to be open-minded when we're that close to historical positive strength that it could start September 1st, even though we see, you know, like as an example in soybeans, if this is the 1st of September, historically September is soft. And when you look at corn, it tends to rally a little in the first of the month, but ends up the month of September usually at the low. But you can see for corn, October, so if we look 1, 2, 3, 4, 5, 6, just counting to this big bar, 5 of 6 months historically on corn are positive going forward. And you can see that 1, 2, 3, 4, 5, 6, 7, 8, 9 months in a row are typically strong for soybeans going forward. So just want to kind of keep you heads up to the seasonality on 2 of the 3 grains. The wheat seasonality is not bad, but it's not as positive as corn and soybeans. So I haven't overlooked wheat, but that's why I didn't put it on here. It's not quite as positive. But in keeping in theme with the grain sentiment, this is the grain ETF, JJG, on a weekly basis over the last roughly 8 years. You can see it's not been a place to be, as it's traveled from about 67 a share down to where it stands at 25 right now. but a few counter trend rallies have taken place near this falling support line. So I'm just keeping my eye out here. What am I looking for? I'm looking for a break of this steep falling resistance, possibilities of reversal patterns here. Sentiment, understandably, on the grains is very low, and so is momentum. So again, I'm not attempting to catch a falling knife at this time, but I'm very much open-minded and watchful of reversals due to the seasonality patterns, particularly of soybeans and corn going forward. Here's a look also at an update. We've been discussing sugar several times in the sentiment on Fridays in the sentiment sector report, excuse me. There's a possibility, I mean, there's no doubt sugar has not been sweet. It's been very sour if you'd have to be on the long side, almost a head and shoulders topping pattern here, and then just a huge collapse. Sugar is one of the least liked commodities of all commodities out there. In other words, bullish sentiment is very low, and there's a possibility of a double bottom here. So I have an alert set at the 2978 level that if we would see a breakout from here, I'm interested in owning sugar. And again, it's done terrible. The trend is definitely down, but there's a possibility that's doing some basing here. And if it would break out, I'm interested in owning it with a tight stop. As a reminder, this was again in last week's sector report. These are the top 20 S&P 500 stocks in the month of September over the last 10 years. So I've continued to put I put several charts from here in last week's sector report, and so I have, I don't know, probably out of the 20, probably 11 or 12 that have some possibilities of upside breakouts, and so there are alerts set on several of those that if they would break out to the upside, we'd be buyers. So just a quick look at our positions. In the upper right, I'm just going to start off with the positions that were actually closed last week or harvested some of the position. You can see we took some of the FXI, which is the China long position, off for about just short of an 8% gain in about 6 weeks. Freeport-McMoRan was owned for around 100 days. This was the remaining 40% of the shares that were owned. Closed that with just short of a 26% gain. Pulled some of the shares off of Harris Corporation, which was an August seasonal strong stock. And then PSQ, which is the inverse ETF of the Nasdaq, had made almost 4 bullish reversal wicks in a row. Keep in mind this is an inverse, so it's falling. Looked to make possibly 4 inverse reversal patterns in a row. So I went and bought a small piece of PSQ. I wasn't bearish because of it. I just liked the pattern. And then I set a stop right below those wicks, and we were taken out of the position last week with a loss of 2.4%. Today, in hindsight, if I'd maybe left the stops a little sloppier, we'd still be in it, and instead of a loss of 2.4%, might be down 1.5 to 1 at this time. So completely open to going back to it. But as a reminder, a few very good members, just because I went and bought that, you have to keep in perspective, that's just taking a chart pattern, not trying to take a bullish or bearish, attitude. Just because we own one inverse, I think some people forget that, well, gosh, he's got a 90% long position on the other side. So just because we buy those, if you see me buying PSQ and shorting the S&P and having no longs, I think that would be a lot different than having a bunch of longs and just putting a short-term position on the short side in there. So then this is the remainder of our long positions that we have. Again, you should receive these in your email tonight. We're sending position updates now on Tuesdays and Fridays to all of you. So just real quickly, we'll look at just a few chart patterns on the positions that we own, starting with the oldest. This is a XLF that was bought last summer. So this is a year that we've had this position, but as XLF was breaking above resistance right in here, we bought it. took it for a ride, and then we've sold off the majority of this position at what we thought was a resistance. We have just a small part of the shares that are left in case we would have an upside breakout. We still have some ownership. If XLF would break out to the upside, I'm totally open to repurchasing it and loading up again. But right now, I'm not seeing that evidence to go and do it. We pulled our stops up, on this position. So an important test off the 2015 lows, this rising support line, is taking place at 3. If that support line would be taken out, the remainder of our shares would be sold. So, but just as we said at the beginning of the webinar, banking shares on average are actually lower today than they were before Christmas last year. This is the AGG bond fund that we looked at earlier. It was purchased last year before Christmas, and potential double bottom and a rally, a nice move up. This is a weekly chart. That's just today's action. Again, we discussed this earlier. There's a negative bearish reversal wick there. We pulled our stops up, but if this would continue and close above that bearish wick, that would obviously send a positive message to this AGG bond fund. Here's EFA. We still own some remaining shares of EFA. It is nearing long-term resistance. The couple-year trend is up, but you can see in 2015 and 14, this price level in the $68 range has been an influence. You can see that it was a key low a couple of times. Here in the 2007 and 8 range, once it broke, it waterfalled down. You can see a fake out up here and then a decline, hit it, and then followed by another decline. So this is a key overhead resistance level. Again, we've sold off some of the ownership of this and brought up stops on the position. If we'd see continued weakness, we'd be stopped out. And as a reminder, relative momentum just a couple of months ago was the highest that it's been since the 2007 peak. Here's a look at Citi, owned shares in Citi. As it was pushing up against resistance, we started to see a breakout here. We bought Citi. We've got a decent small gain in the position. This is a reminder. This is a monthly chart, so you can see over the last few months, Citi it's been flat. It's been trading, sideways. So today we saw the key S&P 500 sectors as interest rates fell and banks rose. The banking index was, I believe, one of the weaker indices of the 9 S&P 500 sectors. Here's a look at the China FXI ETF. It was forming one of our favorite patterns, a bullish ascending triangle in an uptrend. And as it was breaking out, we bought FXI. We see that further breakout. We started harvesting some of the shares last week as this potential resistance was coming into play. And again, this is a weekly chart, but that's just 1 day's action. But you see some back off of FXI after hitting resistance. So maybe we got fortunate on where we sold some of the shares and we raised the stop. So if we would see much further weakness, we would be stopped out of the position with gains. Harris is a August seasonal strong stock. And again, what appeared to be a bullish ascending triangle, rising support, and a breakout. It was bought. You can see the average gain during the month of August is 596. And I think so far, we didn't buy it on the 1st of August, bought it a little bit later, but our gains coming in prior to today were, I think, around 5.2%. So Harris, so far, or in the month of August, performed fairly much close to norms, outproduced the S&P 500 almost by 5%, as the S&P was flat during the month, and Harris picked up the 5%. And everyone, that's what we're trying to do with the seasonal stocks is to try to find alpha in positions to where that we can outpace the broad market. Even, yes, if the S&P would fall 5 to 10% in any given month, I don't think the seasonal pattern would mean a lot, other than maybe that stock wouldn't fall as much. But this is the type of thing that we're trying to provide research for you to share the stocks that typically do well in any given month, and even if the market is flat, that maybe we can go find some value by owning some of the stocks. And overall, we've had more luck than not in doing that in our positions for months. Well, I guess we're right at the end of the webinar. I thought I had another slide in there, and I apologize for that. But I want to thank all of you again for your membership and the good insights and questions. I want to put it out right now that next month we're going to ask all of you premium members to shoot some of your questions to us that we can discuss on the October premium webinar. We're going to try something a little bit different. You deserve that. So we would appreciate, your feedback. So be thinking about things, and we'll remind you of it, along the way. You get some emails from myself and Rick, but we're going to try to mold in and make part of the webinar things that you're interested in beyond some of the things that I see from a chart interest, perspective. So again, thank all of you for your membership. I hope you had a good summer, and we look forward to speaking with you the first Tuesday of next month. So take care, everyone. Thanks again.